This is a gold bar. When you look at it, you see a shiny, heavy metal. But when you really look at it, you find a paradox. It sits in a vault doing nothing. It doesn't generate any income, it doesn't pay dividends, and you can't really use it for much in the modern economy. In the digital age, it feels like an ancient relic. And yet, central banks, the most powerful financial institutions in the world, are buying it in record amounts. They're hoarding this seemingly useless asset as if their lives depended on it. This goes against everything we think we know about modern finance. Why would institutions obsessed with stability and growth bet on a worthless rock? For decades, economists have dismissed gold as a barbarous relic, a sentimental holdover from a bygone era. Even the legendary investor Warren Buffett famously said that gold is dug out of the ground in Africa or someplace. Then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility. Anyone watching from Mars would be scratching their head. And he's not wrong. From a purely practical standpoint, gold is strange. Its industrial uses are limited, mostly in electronics and dentistry, but that only accounts for a tiny fraction of its total demand. It doesn't generate cash flow like a stock, it doesn't pay interest like a bond, and you can't live in it like real estate. If you buy an ounce of gold today, in 50 years you will still have 1 ounce of gold. It won't have produced anything. Its value is based purely on what someone else is willing to pay for it. This makes it seem like a purely speculative asset, no different from a rare painting or a vintage car. So the question becomes, why are the world's most conservative financial managers, the people in charge of entire national economies, stockpiling something that, on the surface, appears to be completely worthless? The answer is a masterclass in risk, trust, and the hidden mechanics of our financial system. And it all starts with a single crucial concept that makes gold unlike almost any other asset on the planet. This is a video about the strange logic of gold and why central banks can't quit it. That's insane. It holds a power that defies spreadsheets and financial models, and to understand it, we need to look past its uselessness and see what it truly represents. Gold's real power lies not in what it does, but in what it doesn't have. Every other financial asset you can think of is a promise. When you own a stock, you own a piece of a company, but its value depends on that company's performance, its management, and the overall health of the market. It's a promise that the company will generate future profits. When you hold a government bond, it's a promise from that government to pay you back with interest. Its value relies on the government's ability and willingness to honor its debt. Even the cash in your pocket is just a liability of the central bank, a promise that it holds value. All these assets have something called counterparty risk. That's a fancy term for the risk that the other side of the deal, the counterparty, won't hold up their end of the bargain. A company can go bankrupt, making its stock worthless. A government can default on its bonds. A currency can be devalued by inflation, eroding its purchasing power. Gold is different. It is an asset that is no one else's liability. When you hold physical gold, you don't depend on any institution, corporation, or government to make it valuable. It doesn't require a signature on a contract or a government guarantee. Its value is inherent, recognized globally, and exists completely outside of the traditional financial system. There is no CEO who can mismanage it into the ground. There is no government that can print more of it. For a central bank, whose primary job is to manage risk, this is an incredibly powerful feature. They manage trillions of dollars in foreign exchange reserves, mostly held in the currencies of other countries, like the US dollar, the euro, or the yen. But holding another country's currency means you're exposed to their political decisions, their economic policies, and their stability. If geopolitical tensions rise, those assets could be frozen or lose value overnight. Gold, however, is a neutral asset. It belongs to no single nation. In a world of complex interdependencies and growing geopolitical friction, holding an asset with zero counterparty risk isn't just a preference, it's a strategic necessity. It's the ultimate financial insurance policy. This brings us to the real reason gold sits in those fortified vaults. It's not there for a sunny day, it's there for the storm. Central bankers are not paid to be optimists, they are paid to be paranoid. Their job is to plan for the worst-case scenarios, the so-called tail risk events that have a low probability of happening but would be catastrophic if they did. Think of a global financial crisis, a major war between world powers, or a complete breakdown of the international monetary system. In these extreme situations, the promises that underpin our entire financial world can evaporate. Trust in currencies can disappear. Credit markets can freeze. The intricate web of digital ones and zeros that we call money could fail. What happens then? In that moment, gold becomes the ultimate safe haven asset. Throughout history, during times of war, hyperinflation, and systemic collapse, gold has been the one asset that has consistently held its value. When national currencies become worthless paper, gold is still gold. It's a universally accepted medium of exchange that transcends borders, languages, and political systems. A central bank holding gold has a powerful tool at its disposal in a crisis. They can use it to settle international payments when no one will accept their currency. They can sell it to obtain foreign currency to stabilize their own, or they can use it as collateral to secure emergency loans. In 2008, during the global financial crisis, the system came terrifyingly close to a complete meltdown. Trust between banks vanished. But even then, gold was a liquid asset. Central banks could and did use their gold reserves to provide liquidity and calm the markets. It's a fire extinguisher in a world built of flammable promises. You hope you never have to use it, but you'd be a fool not to have one. Holding gold is a central bank's admission that the system they manage is, ultimately, fragile. It's their protection against the unthinkable. But gold does more than just protect against disaster. It plays a subtle psychological role in the day-to-day functioning of the global economy. It builds confidence. For a country, especially an emerging economy, a substantial gold reserve sends a powerful signal to the rest of the world. It says, we are a credible and stable financial player. It's a mark of financial sovereignty and prudence. Think about it. If a country's central bank has large reserves of US dollars, it shows they have faith in the US economy. But if they have large reserves of gold, it shows they have faith in themselves. It demonstrates that the country's wealth is not entirely dependent on the policies of another nation. This credibility can have very real economic benefits. It can lead to lower borrowing costs on international markets as lenders see the country as less risky. It can help stabilize the national currency as investors have more confidence that the central bank has the means to defend its value. In a world where perception is reality, a vault of gold is the ultimate financial statement. When countries like China and Russia have been aggressively increasing their gold reserves over the last decade, it's not just an economic decision, it's a geopolitical one. They are signaling a desire to reduce their dependence on the US dollar-denominated financial system and assert their own standing on the world stage. Gold acts as a neutral anchor of trust in a system that is often swayed by politics and power. The presence of that silent, gleaming metal in a central bank's vault broadcasts a message of strength and reliability that no amount of digital currency or government bonds ever could. It's a silent guarantor of a nation's financial word. Ultimately, we have to understand that central banks don't think like ordinary investors. You and I invest to make a profit. We buy assets hoping their price will go up so we can sell them for more than we paid. Central banks don't operate that way. Their goal is not to get rich. Their goal is stability. They're playing an entirely different game. For a central bank, gold is not a profitable investment. It's a strategic asset. The cost of holding gold, the storage fees, and the lack of a yield is seen as not a loss, it's seen as an insurance premium.
Just like you pay for home insurance not because you expect your house to burn down, but because the consequences would be devastating if it did, central banks hold gold to protect against systemic financial fires. The return on gold is measured not in dollars and cents, it's measured in the stability it provides, the confidence it inspires, and the options it creates during a crisis. Its performance is best when everything else is performing its worst. It's the ultimate portfolio diversifier because its value is often negatively correlated with traditional financial assets. When stocks and bonds are crashing, gold tends to shine. This is why the criticism that gold does nothing completely misses the point. Its value lies precisely in the fact that it sits outside the system of doing. It's a strategic reserve of trust, a financial backstop that is independent of any single government or institution.
In an age of unprecedented debt, digital currencies, and geopolitical uncertainty, the barbarous relic is looking more and more like the wisest asset in the room. The great enigma of gold is that its perceived worthlessness is the very source of its ultimate worth.